recording. And it said, what, like, what's the importance of coming to this webinar? It's just employment-based pay and variable pay. Seems like pretty basic, but there's a lot of questions about it. So we're here to show you where many mortgage pros go wrong, show you how to avoid some traps, and help you create a streamlined, review for your processing underwriting. And what helps is we're going to show you our calculator. If you're not a client, a Blueprint income expert, good news is you don't have to worry about writing a bunch of math down today. We have a tool that's going to do it for you. But I find it super important for you to trust the tool. You have to understand the why behind what it's doing. So I've been underwriting for a long time, 32 years, and I'm one of the co-founders. And so this thing has been vetted by over 100 plus underwriting managers because we have 150 plus banks working with us. And so we get a lot of input. Fannie and Freddie use us. We're very been around 13 years, 3.5 million loans. So there's a lot of stuff we've learned to really complete a complete process, is I guess what I'm trying to say. So, you know, everything about underwriting, you should learn to do things systematically. Now, look, we know there's exceptions and one-offs and thing, but pretty much if you learn to follow a process with anything in the manufacturing of loans, you'll get better and better at it, and you'll learn to kind of pick up where you're getting things wrong or where inconsistencies are. And when I was running underwriting teams, this is what I had to do was we couldn't have it Susie doing it one way and Bobby doing it a different way. We really had to create a system. That way, when Susie or Bobby were on vacation, we didn't have to like re-underwrite the whole thing and get a different answer to our partners that were selling the loans, the loan officers, right? That's a good thing to happen. So we always talk about step four income analysis because we're Blueprint income expert. We do income analysis. So let's get ahead and get started here. So, all right, a couple quick things. We got to set up a thought process for you. Is number one, remember the thing about all income is that it has these four rules for all income. It's kind of like, the prime directive rules. Your income must be reasonably continue for 36 months. If you're aware the income is not going to continue for 36 months, you can't use it. So it's easier like yours define expiration dates like on child support or assets as income or contract employees or like that. But if you have a job and you have no reason they're going to quit and they've been working for 2 years, you can assume they still would like to eat and have a house and pay for their education or drive a car. So there's no reason to think they're going to quit. So reasonable expectation for 36 months, stable to qualify. And we get in the second half of this talking about the variable income. That's the key is you have to look for stability. The agencies, all of them, are not looking for the best income or the worst. They're looking for the income most likely to continue. Number three, income must have the required history to qualify. Now, for employment income, typically speaking, you have a 2 year history of working, right? So, and it doesn't do the same job, just working. It should be the same in some cases. Obviously, you don't want to be using somebody that, worked at Ford for 20 years and are now a cell phone salesperson and they're on commission only. That would not make sense. So there's nuances to that required history. And then, of course, you got to properly document it to qualify. So that's the four requirements of all income. And when we think about income, we got to think about that 36 months into stability is what we're going to focus on today. Okay, base pay defined. So a couple things I've seen we do about 30,000 loans per month with our software, right? So, it sometimes a little bit more. I think when it was really busy in 21, we did like 60,000 loans a month when everybody's getting those 3% rates, right? So we've seen a lot of loans. And here's what I'm seeing happen in what we come in is remember, base pay is the foundation of your earnings. It's not the total amount earned. When you think about base pay, it's salary, hourly wage, multiplied by fixed schedule hours. What we're not talking about, we're talking about base pay is overtime, bonuses, commission tips, other incentives, or things like health insurance reimbursement or retirement contributions. Those aren't really income. Those are kind of benefits. So we want to think about base pay. Now, the bigger thing that we're seeing is people, I think they're looking for the word base pay somewhere, but base pay is, I don't really ever see it called base pay too often. It has a lot of other names. But I like to when I'm teaching about income, and this applies to overtime, bonus, commission, you got to look at the term that the employer is using and fit it into a family or a group, right? So when you see base pay, hourly or salary rate, that's base pay. But what about sick pay? That's base pay. What about vacation? That's also base pay. What about PTO? Also base pay. What about shift differential? Maybe it's base pay. Okay, and we'll explain maybe in a bit. So what I mean by is it, base pay, like here's a typical pay stub, right, that we get in because people upload documents to us and we read them. If you look at this person, they make 21.64 an hour, and over the course of 2 weeks, they worked 86.2 hours, right? This is a couple of week paycheck, which is weird because it's over 80, but they have some holiday pay, they have some personal, they have some vacation pay. Maybe this is a monthly paycheck, it was kind of weird, but what I liked about it was these are all base pays, right? You can see the rate's the same. And this one's easy kind of figured out. There's much more difficult paychecks figured out. But what I'm trying to convey here is remember, when you're trying to analyze everything, you got to make sure that you group the pay properly. Put the base pay with the base pay family, put the overtime with the overtime family. When I show you our software in a few minutes, it's going to show you like the way it groups like that. So this is, again, what we see coming in digitally, and the computer reads it, and it's going to sort it out this way. So when I say base pay, I'm not looking for the word base pay. I'm looking for what is the core behind base pay, your regular salary hourly wage. That's what we're looking for. All right. So easy peasy things are base salary. Now these have a lot less flexibility or variability to them, but we also know, salary is kind of like, hey, weekly is take your week pay, like $1,000 times 52 divided by 12. Your base pay is 43.33. Because in the mortgage business, everything is monthly. We pay the mortgage bills monthly. We have to break everything down monthly, right? So that's how we do it. Biweekly, 26. Now this is the most common pay period out there. And this is for a lot of reasons. Even if you have a company like ours where we have mixed salaried and hourly employees here, we pay every other Friday or every other Thursday. And the way you can tell right out the bat if something is a biweekly versus a semi-monthly, a semi-monthly's first pay period should be the first through the 15th, right? And I've never really seen exceptions to that. I've never seen. I'm not saying there isn't. I just never see it. So if you see a paycheck, it'd be 1 through 15, and it doesn't matter what day the 15th is. It could be a Saturday or Thursday. It's just 1 through 15, and then 16 to the end of the month. And if you get this wrong, if you think about it, let's say I got $1,000 every other week for salary. My salary would be 26 grand. But if I get $1,000 semi-monthly, it's 24 grand a year. These are the biggest errors are made because sometimes these biweeklies can fool you. They will have a payday or a pay period end date on a 15th or end of month just because it just happens to be that Friday, right? But you got to really look at it. Is it 80 hours, which is biweekly, or is it 86.67 hours, which is semi-monthly? Also by the pay frequency. Now, rarely do you see the monthly salaries, typically executives or commission people. Most people don't want to wait 1 month at a time to get a paycheck, right? Maybe government employees, I think they get it twice a month, but you don't see that too often except for high-end income earners or people on commissions or things like that. So no big deal there, right? Pretty basic. Now we're going to start getting into the hourly. This is where things get confusing. Now we're talking about base pay. We have to determine, and this is where a lot of errors are coming right now, is your base pay really fixed? That's all we're trying to figure it out. Is it fixed 40 hours a week? Is it fixed 26 hours a week? Fixed, right? We don't need to average things if we know they're fixed, but we do need to average things if they're not fixed. So we have to ask these three questions. What should the borrower be earning? What is the borrower actually earning this year, and what has the borrower earned either, last year and the year before or just last year? The problem is in QC, people are not doing enough math, which is another advantage of using software like ours because ours does enough math. Again, I've been underwriting for 3 decades. I would be lying to you if I told you I eyeballed this stuff many times, right? I had to look at each year, divide it by 12 or divide 6 or whatever the months were and go, okay, 6 grand, 5,800, 5,700 seems pretty level to me, right? I didn't do percentage changes. I just kind of eyeballed it. And, I had sheets and formulas and tolerances. I'm not saying I was sloppy. I wouldn't have made it 3 decades as an underwriter if I was. But if you don't do enough math, it creates QC problems. That's all I'm trying to say. So this is the questions we're asking. What should we be earning? What is the borrower earning? What has the borrower earned? So let's break down how we answer that mathematically. Step one, what should the borrower earn? So if I'm trying to, what we do with our software, what I recommend you do if you do it by hand or whatever, is use your chalk line as 40 hours per week. Just assume they worked 40 hours. It's going to show up in math really quickly if they don't. You're not going to like miss it. But if you don't have this chalk line that you draw and figure it out as where they should be, then you're gonna have a problem. I mean, if you think about that, you get in your car and Google tells you, or your Apple Map says you'll be there in 2 hours. Okay, hey, it's 4 o'clock, honey. I'll be home at 6. Well, sometimes you show up at 6:10, sometimes you get there at 5:50, but you expected to get there in two, and you kind of calibrate off of that. And so that's what the 40-hour calibration is, the chalk line, right? 22.75 per hour, 40 hours a week, 52 weeks in a year. That's 47,320 divided by 12, 39.43 per month. And you know what? I just would take 2720 2275 times 2080 divided by 12. And just in case you're not familiar with that number, 52 times 40 is 2080, right? So that's my chalk line. They should be making 3943.33 per month. Now, I'm going to look at my income documentation and I'm going to look at my year to date and I'm going to get my denominator figured out by looking at the pay period end date, not the paycheck date. Remember, if you're doing math and you get paid on the 15th, but like you're getting paid on the 15th for money up to the 10th, dividing it by, zero point 0.5 in a month, you are stretching out their pay over a non-paid period. The pay period is what we go off of, not the paycheck date. Because typically speaking, with salary paid every other week, or well, not salary, but hourly paid every other week, there's 1 to 2 weeks lag in when their pay period ended. Generally, it's 1 week. So, especially on the biweekly, won't happen in the semi-monthly. You rarely will ever see hourly borrowers using semi-monthly, right? That's salary kind of thing. So you want it, you got to do the math. So pay period end date. Now, step two, what is the borrower actually earning this year? Now, this is early in the year. This is where I write a blog every year called The Zone of Confusion, because when you get a pay stub dated January 10th, it's going to say, oh, he made 3 grand in these 10 days. Well, if you take, January 10th into 30, it's roughly 0.33%. It almost looks like the person's making like $14,000 a month when they're making six. And the reason is the crossover. So early in the year, it's really confusing. But so I just use a 630 example to kind of break it up a little bit. But when you look at all the base pays, PTO, vacation, base, add them up, 24,612, and they say it's the 630 pay stub. That's a solid 6 months. You divide that by six, 4102. Now remember, my chalk line is 39,433. That's what I'm going to be qualifying with. The math shows me they're on target. And in theory, it doesn't really matter what they made last year. Now, I'm not saying 100% of the time it doesn't matter what they made last year. What I'm saying is, um, because what you made last year, year before, there's pay raises and all kinds of stuff that it's going to be lower. But sometimes people can work like a variable job where they work like full time the first few months of the year, and then they drop down to part time in the summer and then full time in the winter. Like I'm in Michigan, so like a ski resort worker would be working like crazy, and then they probably work a lot less hours in the summer and they make a lot more. But your previous years, our next question, what has the bar earning, will show you that. So you look at the year-to-date earnings this year. I'm sorry, in the previous um, pay stub, right? So this is 26. I need to get some documentation of the base pay only from a final pay stub or a VOE. Now I know people say, well, take the W-2. The W-2, I call it dirty money. It's remember, it's a taxing document. It's not an income document. I mean, yes, it reflects income, but it's more focused on taxes. How much did you earn, right? I made 200 grand. Well, my base salary is only 100. They don't care. If you made 200 with bonuses and commission, you're getting taxed on 200 grand. That's how it works. So that's a taxing document, not an income document. So if you can figure out the base pay by getting a year-end pay stub or a VOE, you take their base pay divided by 12, and you can see last year they were earning 3814. Now, FHA requires you look at the last 2 years, and now Fannie and Freddie have officially put out they only care about the last year, so they have a shorter time horizon. So that 3-4 update that Fannie Mae put out, back on 3-4 a few weeks ago, they're just saying, just don't worry about 24 anymore, right? Don't worry about the prior year. Just worry about the most recent year. So now they're doing like year to date plus one is all they're doing, right? And we're going to update our software when it's in place June 1st. But so right now I do that. So I've done my 3 questions. So here's visually what that might look like. Here's what I should be earning calculated. My year to date is supporting it. So that mathematically tells me that I am full time. Again, look for the things like they're seasonal or you see W-2s much lower last year, but this is supporting it. And then last year, it seems within reason for pay raises, right? So that's what it looks like visually. Now, here's the problem. If you do the math and you're supposed to be making 39.43, but your year to date says 2,900, well, if you give me one paycheck that's 40 hours, and that's why I was thinking you were doing it, you kind of fooled me, right? As an underwriter, is that, well, they should be making that, but guess what? When I did your year to date math, whatever the pay stub date is, get your denominator, divide it out. This is what you're averaging. Then I sit back, and go, oh, okay, that's weird. Why are you not making that? And then I look previous, 25, 24 in a VOE or year-end pay stubs, or maybe eyeball a W-2. You've never made 39.43. That's the QC problem. And when I was a QC manager for 3 years, auditing underwriters' work, this is what I'd see. I'd see the 1008 say, they make 22.75 an hour, year date supports. No, it doesn't. Did you do the math? Like it would only take you a second. This is when you're eyeballing things or you're in a hurry and you don't do it. That's why our software goes through so dramatically and does the work for you. And that's what we're shooting for. Okay, so compare your results. Does the calculated, you compare, what you do is you compare calculated to year to date. Is it within 3 to 5%? Now our software is set to 3%. So if the year to date is within 3%, so if it's, 4 grand calculated and 39.50 year to date, we will use the year to date, the lower, right? Because we don't know why it's off. Pay raise, whatever. That's the more conservative or compliant answer. Now, if the year date's a little bit over, I will use the calculated. Why? Well, you can't make more than your calculated pay unless it's like vacation buyout or some other weird base pay they get paid once a year. And then again, remember, you have to document that it's ongoing for 3 years. Are they going to buy their vacation out every year? Maybe you can use it. I mean, that's where the nuance comes in. That's what requires some experience in underwriting to kind of get your handle around there. So if yes, use the lower the calculated year to date. If the year to date does not support the calculated, well, now we have to assume variable pay, right? Or did you get a pay raise? Were you off? Did you start the job 3 months ago? These are the questions that the underwriter needs to ask. So, recent pay raise. Did you go full time from part time, right? Are you a seasonal worker? Maybe I put in 40 hours, but you're a dental hygienist and you work 32, so I need to fix my calculator. Or you're a teacher and you get paid 10 months a year, not 12. This is where the skill comes in. Our software does the grunt work for you, but you still have to use the risk analysis part of your, thinking it through in your experience. And this is why we like to teach the why behind the what. So the math, we do all this stuff and it gives you the ability to make this decision. Okay. So let's just stop here real quick. Let me pull something up on our software. And there we go. So let's show you an example of what this is doing in a live sense. Okay. So if you've used our software, we have a modular basically employment calculator. So if I'll go ahead and open test up and do this. Oop, shift it, F11. No, control F11, Mike. Okay. For some reason, the function command is not working. Let's try it one more time. There it is. Okay. So when I've got my calculator and I'm making, $25 per hour, because we're talking about hour thing, I'm going to assume that we're working 4 hours. Our calculator always starts at 40 hours, by the way. And I've got this 228 pay stub. So if I look at my calculator rate, they should be making 43.33. So that is $25 an hour, full time, right? My year-to-date pay is 8,100. So this said, so on the pay stub, it said base pay. Now remember, this is 26, this is 25, this is 24. So there's my W-2s, which has all kinds of extra stuff in it, right? Because 4,300 times 12 is nowhere near 115,000. So they've got a lot of bonus or commission or something going on there. But you got to remember, I make sure we put all of our base pay family in there. So in our modular calculator, what it works is like you look at the pay stub and you go, oh, it says base pay. And this year says 8,100. And there's my categorizer right here. You say it's base pay. Now, for those wondering, if you are one of our clients, you can upload all the documents and our system does this for you. But if you're using our guided income review, which I'm showing you now, you're going to type the data in, you're still going to get the same answers. All you got to do is be able to read a pay stub. Now, I see there's PTO on there, $500. Guess what? PTO is not overtime, tips, commission, other. It is base. So our system will automatically add this plus this. It will not add overtime into the base. So if I look down here, $8,600. So if I take 8,600 divided by 2 full months, that's 4,300. The system is automatically comparing year to date versus calculated. And since the year date's a little low, it's just using that. Now remember I said 3 to 5%, so there's my 5% threshold. Now what if this said 7,400, right? And you still had the PTO, and I hit save calculate. What would this calculator do? Well, it moves over, sorry, something I was looking at real quickly here. It moves over the year to, like it says zero. Like it's like, was a huge drop. Well, why is there a 58% drop? Well, now it's looking at your W-2 and it's a bunch of things like, well, that's a lot lower and it's not supporting. So it's assuming variable. So it will automatically go calculated or year to date, and if it drops out of that little 5% range, it then switches to full variable pay. Right now, it's going to compare all these numbers. Like I said, this isn't a great thing to do because, um, you know, the base pay is mixed into that. So basically, you need more documentation. So all the work I just showed you and all the slides, it's doing for you in just seconds, right? So it's comparing and it's alerting you to things. And down at the bottom, it tells you like, hey, the base pay decline is over the company guidelines, and the guideline just being the threshold, right? So we set it at 10%, and I know people go, that seems kind of low, but Freddie Mac's even come out and said 0 to 10, no explanation about up or down really needed. Over from 10 to 30, we need an explanation, up or down. And so Fannie and Freddie are like brother and sister. They have the same parent. So even if Fannie doesn't say it, brother Freddie said it, and FHA and VA do a better job at, well, especially FHA, do a better job explaining it. Okay. So that's what the calculator is doing. It's the saving grace of the calculator. So, all right, let me go ahead and go get rid of the full screen again, go back to my slides. Now let's talk about variable pay. Base pay is pretty easy. We got to take that same that's weird. Nobody opens right up. Let me see what's going on there. Again, working remote sometimes. Sometimes it kind of, there we go. Push the right button, Mike. That would help. Stop blaming the computer for everything. So, okay, now let's talk about variable pay. The same basic things are going on, right? Fixed versus variable pay. What makes income variable, right? So, same rules, 36 months, stable, required history, document. We know all that already. For reference, here's where all the guidelines are coming from, but let's get to the heart of it. What makes an income variable? Any income that you have to average. Okay. If it's not fixed, it's variable. It means you got to do an averaging method. And what do they mean by averaging method? So if I have overtime, bonus, commission, tips, shift differential, vacation buyout, RSU, other income, or base pay that's not fixed, it's variable. So we can't just do a simple year-to-date calculation. We have to look over a longer history of time. The guidelines say, Fannie and Freddie, I'm mainly focusing on here, that you can have, if you have variable income, no less than 12 months of variable income, but they prefer two, right? You cannot have somebody with variable income for 6 months and qualify them unless they were moved from another job that was variable, right? Then fine. And remember, it's not one job, it's your history. So if you switch jobs, you could put them together and figure it out. But if I have a job now and I've been there 8 months and I'm variable pay, I can't do it. If I worked at, McDonald's full time and now I'm over at, you know, Amazon and I don't have fixed hours yet, too bad, so sad. We can't get it yet. You just have to wait for them to mature out their income. So other kinds of income that are also variable, and we're not talking about them today, but dividends and interest, self-employed, real estate owned, royalties, right? Royalties probably more fixed, but I'm saying it's not just limited to employed, but that's what we're talking about today. Okay, so here's a clip from so first of all, the 36 months, we've already kind of went over, sorry. This is the defined expirations. We already talked about that. But what we're talking about is base pay first. How do you know base pay is variable versus fixed? Remember, base pay is the agreed amount of standard per rate of pay expressed in hourly rates, because salary is not variable. If your rate changes or your hours change or your rates and hours change, that is a variable income borrower. Nurses are notorious for that, right? They have weekend shift, night shift, day shift, all, whatever shifts, right? Too many shifts. So that's the problem. So once you have variability in any of those or all of those, you got to start doing more averaging. So that's when you trigger it. So we got to keep in mind our goal, and because the guidelines tell you, you have to now figure out what's the most likely income to continue for 3 years. Because you don't want to do is issue somebody a 30-year loan and give them the best income ever they've had for the last 2 months and then wonder why they're going to be in foreclosure 2 years. Again, I can tell you as an auditor, part of my auditing job was auditing defaulted loans, right? So I audited underwriters and then they would send up fraud and defaulted loans to us and go, what happened? Right? And we looked and went, "Well, this person was variable pay and the underwriter missed it. So they qualified them on their best paycheck ever. And within 2 years, between, the 12-month foreclosure process, they crashed. They basically made 10 payments and fell apart. So you're not doing anybody a favor by treating them like they're full-time when they're not. So, is the income stable or increasing, right? Up or down? Was it declining and now increasing, or is it declining? So, you're taking a different question on variable income. But it's just, you have to do all the math first. What should you be making? What are you making? What have you been making, right? And then you're going to look at them from a trending analysis. Now, I'm going to put the word recommendation here, and I'm not some kind of underwriting authority. I'm not the GSEs. I'm not the CFPB. I'm just a guy who's been underwriting for a few decades. Here's what is found in the guidelines. Freddie came out and basically said 10% below, don't worry about explaining it, we'll take it. So if the income is going down 10%, use the lower. If it's going up more than 10%, use the average, right? So whichever one's lower. 10 to 30, they say, yeah, you can still use it with a good explanation. Now, here's where they kind of catch you at. They never really say no, right? The guidelines are guidelines. They in most cases, right? Some you can't break, but guidelines mean you should be in this range unless you got something special. 30% or greater is not really defined. What that tells me is you're over 30% and that loan defaults, you better have one heck of a write-up on your 1008. There got to be something severe that because you're putting your neck on the line for it. 10 to 30 is a reasonable thing. Over 30, that gets to be unreasonable. So again, can't point directly across all the guys in here except for Freddie, but this is just experience looking at 30,000 plus loans per month with our software, doing analytics and answering to over 150 banks that use our software. So I'm just trying to give you my insight. It's not just my, opinion. This is where we're getting the data from. Now, you remember when you think about trending, you're looking for green, stable or increasing, yellow was high, went down but recovered, red, down, down, down. What does that look like? Well, this is what it kind of looks like, right? Current year, previous year, previous year. This is nice trending income up. And again, I'm going to have to update my slides for Fannie and Freddie and get rid of that third block because they don't want you looking back that far anymore. But here is a stable increasing, or I'm sorry, but a decline, but now stable. It was high, it went down, it went up, right? So we can't count the old year. And again, with the new guidelines, they only care about year to date in this. So they're going to want you to average those two together. FHA would still want you to, probably use it. Well, they're going to tell you to use this lower one in the middle because the way they do it. And then declining, down, down, down. Now, can you use a down, down, down? Sure. But what you can't do is mix in the downs with the current. You will not pass any odd. There is no exception I know to that. I shouldn't say always and never. I really, like in my experience, yeah, I've never beaten this. Now, remember, I was an auditor for a few years, and all we did all day long was not underwrite, but defend against bad loans. And I was an auditor from 2009 to 2012, which is after the stated income debacle and all the housing crash. So you can imagine we had a lot of defaulted loans, and the agencies were making all these companies buy back, and they had to get bailouts and everything else, right? It was ugly. It was a very dark period in the mortgage industry, right? So you got to be careful, right? And that's what we learned. Like, what beside a commission, what was your reason for approving a down, down, down? Oh, commission. Sorry, buy it back. Because happy you made 4 grand in commission. We're not paying $90,000 to give you 4 grand in commission. Fannie and Freddie are not going to do it. And they're the government. It's kind of like fighting the IRS. You're not going to win. They have the money, we don't. So that's how it works. Okay. So when you do the math, again, this is what it looks like, and the software does it for you. You got June 15 pay stub, you're going to do enough math. Remember, what are you making? What should you make? What are you making? What have you been making? So just like I showed you in the base pay, you look at the current year, figure out your denominator, work out the denominator, all that. So this is kind of an example of what the software is doing for you, stable or increasing. $7,500 as you and I'm using overtime as example just to give you, you could use that on whatever base or anything. You made $7,500 halfway through the year. Great. Last year I made 14.8. The year before I made 13.8. What does that translate into a monthly average? This year's 1250, last year 1208, 1150. Good news, it's stable or increasing. Now, can I use 1250? No. Acceptable answers that are allowed. You could take the 7,500 divided by 12. That's acceptable, right? A lot of people do that. It's only 625. And I'll explain why you would do that in a minute. But the more common one is probably the year date plus 1 year. And again, with the change to Fannie and Freddie, you won't have to worry about this year date plus 2 years anymore. But let's explain the annualization real quick because you can use that quite a bit. I wouldn't probably, even base pay, I guess you could if it's variable. What does annualized mean? It just means divide by 12. So if you think about it, it's a very safe answer. If I made 6 grand of overtime as of June 30th and divided by 12 instead of by 6, which would give me $1,000 a month, it's 500. What if the borrower never gets any overtime after that? Well, guess what? When you look in November, 6 grand divided by 12 is 500 per month, right? The same as June, but it would be 545 if you took 11 months. See how you can't get burned by it? Now, I get it. You're kind of hacking their income down, but it's a very safe answer. And the agencies use that from time to time. So this is an old school desktop originator thing. It used to be in their guidebook back in the 90s when I was starting to underwrite, right? So that's just how it worked. So get back to the math again. What if it's in the yellow? Good this year, good last year, but woo, there's a lot. I had a stellar year of overtime. Well, when I look at the numbers, 1250, 778, that's increasing, but 1583 is not increasing. So my only choices here are taking the year to date or the year to date plus last year. I can't mix in the old. Again, I keep saying this, but I got to change my presentation here because Fannie Mae now and Freddie took this out of the mix. Okay. So FHA still has not, and I don't think they will, but the government or the conformings have. All right, declining. I see you made 35 this year. Last year made 30, 93, 19. When I do my averages, 583 down from 778, down from 1583. The correct answer really is zero, right? Zero. Now, if I wanted to, maybe I could take 291 divided by 12, but I'm putting my neck out in the line. I hope I really, really like that borrower, right? Because if you're going to use it, you better have a really good reason. You can't say they got good credit, they have reserves. I mean, it's more like, hey, the guy broke his leg and was laid up for 7 months, and so he couldn't work overtime, right? Because you got to have something that was like out of the borrower's control. And out of the borrower's control is not my company stopped giving overtime. That's why you don't want to use it, right? Because it's highly volatile. But if it's like the company's still doing overtime, but I broke my leg and I couldn't work overtime for 4 months, okay, that makes sense to me, right? So it's not a never, but just be really careful when you do it. Okay. So quick note about the government. I'll save a little time here. They just do a look back. Okay. So the difference in their math is the year to date really supports that it's ongoing, but you don't really ever use it. Now, again, most cases, that kind of thing. I just really got to clean my slide up. Boy, I got the years all mixed up there. So a little editing needed on here. But anyway, the math's right, but just ignore my years. So when I do my math, 1250, 12.8, 1150, I'm going to use the 1191. Well, what's that number? Well, that is my 25 plus 24 divided by 24 months. That's how FHA likes it. So year to date says I'm currently getting it, but I'm going to use the last 2 full years. And if you think about it, that's a beautiful way to do things because you don't really know when people are making overtime or not making overtime, right? Think about the mortgage business. Do you make more in June, July, August than you do in November, December, January? Yeah. So I would not want to take my June, overtime and go, that's going to keep continuing. You're guessing. You're always guessing. So FHA takes the guessing out of it and they take the historical data. Like, well, okay, you're currently getting it. Is your number on track from the previous years? That's the big difference in they're doing. Okay, so nothing too radical there. They will take it as declining within reason. So if you went from 1583 down to 775 and it's reasonably lower, you could take 775. And I used to say that 1250 was a year-to-date average. It's not acceptable. I got to fix the slide where it's just orange is the only acceptable answer. Some people have debated me if you can use 1250, and I do not see anywhere in the 4000.1 that says that. So I just kind of put that as a footnote. Okay. So, declining definitely can't do it, right? It's not stable. So, we know about the history, 2 years recommended, same job's not required. But if you have job changes, you got to think about the current job more than the old job. So doable, but not recommended. So last part here, I'll let you guys go in a minute. Here's the thing. So when I'm doing so I'm gonna have to have a VOE out, right? And so I don't have any W-2s or I'm not using them. I'm going to go ahead and use my base pay, 25 an hour. Last year, let's see, we made $49,000 in base pay, $48,000 a year before. And we're going to get rid of this because the VOE wouldn't have like PTO and stuff, right? It's going to have overtime, bonus, commission, etc. My VOE says, oh, this year so far I made $1,000. Last year I made 4,000. The year before I made 19,000. So I'm going to show you a few different of the red, yellow, and greens. My bonus this year is 800. Last year was 100, and the year before was $1. Okay, and then one more, I'll throw commission in there. So add a row, commission, and we're going to do 4,000, and last year was 18,000. That will go really high here. 90,000 and the year before is 150,000. We'll just do some crazy declining numbers. So that's commission, save, calculate. Now, all the math you just saw on the screen with my wrong dates in it, right? So it just did it in 1 second. All right, let's start with overtime. You were making 1583, drop to 333, back to 500. Remember that yellow arrow. It's letting you know you've had a 50% increase from, this year to that year roughly. Okay. So you got to watch that. It's stable, but it's got a bit of variability to it. So what do we use? Year to date plus last year. What about the bonus? Well, let's see, the bonus was 8 cents, 8.33 and 66.67. You only need the last 2 years for bonus. So that would be $37. But commission, see how the system's not recommending it? 73% decline. If I look at it, 12,000, 7,500 down to 2,000. That is not stable income. With a 57 or at the 73 or sorry, yeah, a 73% decline between this and that, not stable. All right. So the computer does all that math, and this is the why behind the what. Here's what we're doing, right? Here, and now I just show you how we do it. All the math I'm showing you is how this thing's programmed, and it just gives you a better understanding of where we're coming from. Now, last thing, if you're one of our software users, we often get emails going, "Hey, how come my income is zero? Like why am I not using my commission?" Well, what all you got to do is kind of go, "Wow, that seems kind of low. I thought they made like 14 grand. Let me take a look." Come down here. Okay, that's good. I'm all right with that. Okay, that's good. That's good. Oh, wait a minute. That's where I had thought it was 6 grand a month. That's the difference. Well, take a look at our software. First of all, red arrow, right? Green and yellow are being used. Even green down is okay because it's within tolerance. Red, not good. So we take it out. And we also come down here and say, hey, your commission has got a large decline. Make sure you check it out, right? So we try to do the math, we talk about the guidelines, and we explain to you in the advisories down below. This makes your job easier, more streamlined, and this is why we do so many loans per month, right? Because our clients trust us to do that stuff. So, and guess what? You get your report at the end. Our current clients know this stuff. You get this great report, and all the math I just showed you is all done. You gotta sit there and here, like I'll give you an example. Here's me as an underwriter, chicken scratch all over. Let me see if I can get the paper show up. All the chicken scratch. When I was underwriting as a younger underwriter, I had an Excel sheet and I had a little folder. I had to like scan them in to keep them for like 4 years. So people say, "What were you thinking 6 years ago?" or whatever, and I had it. Well, with our software, you don't have to worry about that anymore because you've got a great report here that you can easily pull up that little report that is nice and pretty, that laid out really nice. Here's all the income. Here's all the types. Here's all the math we did. Here's the totals for you. So you don't have to sit there and type this all out and do a math error somewhere. So that's it. A refresher. Hopefully, again, we get a surprising amount of questions about, we just call it employed. Like self-employed is really nowhere near the questions like we used to have. So that's why I want to go through this today on this webinar. So hopefully some of those tips have helped. I'm gonna go ahead and stop the recording, answer a couple questions, and that way, but if you guys are all set, you can go. But I'll go ahead. Let me get a few questions answered that come in. Give me just a minute to go up here. And thanks for joining today. If you're going to take off, we'll see you next time. You get a recording and slides afterwards, and we appreciate you joining. So one moment here. All right, and we're going to turn the recording off.